There are periods in financial markets when it pays to be a contrarian investor and to go against the flow. But more often than not, it is better to follow the trends because they are more persistent and will lead to a better overall investment performance. At the beginning of 2021, we believe that we are in such a period when it makes sense to follow the trends which have been established mostly in the fourth quarter of 2020. In my CIO update, I would like to highlight briefly 7 trends and point to the respective investment implications. The first trend is the ongoing global economic recovery. The strong V-shaped rebound started last summer and it is still in full swing. Admittedly, it has become a bit uneven on a global level due to the second and third COVID-19 infection waves. In Europe, the recovery might even become W-shaped as economic activity is likely to contract in Q1 due to renewed lockdowns. However, on a global level, manufacturing activity remains strong, driven by Chinese demand. During the year, the recovery should gain speed also in Europe and in the US, which favors cyclical over defensive assets. The second trend is rising interest rates. After being stable at the low level for many months, US 10-year yields started to rise in October in anticipation of the change in US government and higher fiscal spending. On the back of the change in control of the Senate in early January, 10-year yields crossed the 1% mark for the first time since March 2020. Rising inflation expectations are likely to lead to even higher interest rates during the course of 2021, which will have a positive impact on the commodity sectors and on financials. The third trend is a falling US dollar. Higher fiscal spending in the US and higher inflation will continue to weigh on the US dollar. On a relative basis, this should be positive for other currencies like the Swiss franc or the euro, but also particularly for emerging market currencies. Many emerging market currencies are fundamentally undervalued and have a lot of catch-up potential. The fourth trend is rising asset flows into emerging markets. Not only currencies should benefit from a weaker dollar, but also the related assets in fixed income and in equity markets. As a result, the stronger relative performance of emerging market equities versus the developed markets, which started in 2020, should continue. The fifth trend is an ongoing outperformance of small cap stocks versus large caps. Small caps tend to do well in an early phase of the business cycle as they have a higher operating leverage. They tend to have higher growth rates and can benefit most from pent-up demand, which is likely to lead to an economic mini-boom in 2021. We particularly like European small caps, which have the highest catch-up potential. The sixth trend is an outperformance of value versus growth. The reversal of the multi-year trend favoring growth stocks is in its early stages. Value stocks are cheap and should benefit from rising rates, while growth stocks are more expensive and should suffer from higher rates, at least on a relative basis. A particular area of concern is technology large caps, which are likely to underperform. As a result, we also expect non-US markets to outperform the US. The seventh trend, and probably the most powerful, is the asset flows into sustainable investments. Sustainable companies have substantially outperformed during the pandemic, and we expect this trend to last as more money will flow into higher quality ESG names, while companies and industries with the worst ESG ratings will continue to underperform. Therefore, it is crucial to integrate ESG factors into the investment process. We are confident that 2021 will be another good year for investors if they follow the 7 highlighted trends. We expect that investors will become more optimistic over the course of the year and embrace these trends more fully. In our multi-asset portfolios, we stick to our overweight in risky assets and favor equities over bonds and low-quality credit over high-quality government bonds. A proper risk management and a robust diversification, which both served us well in 2020, remain the solid foundation of our portfolios. Finally, let me wish you all the best for 2021, successful investments, good health, and a lot of happiness.